Hello everyone, welcome back to another chapter, our chapter 8, option pricing and its application in finance. Let's open the PowerPoint. Okay, so in this chapter, actually, we need to discuss several terminology. First of all, we need to understand what's financial option. Just read this statement. An option is a contract which gives its holder the right, but not the obligation, to buy or sell an asset at some predetermined price within a specified period of time. So this is kind of agreement that someone agrees to buy something in future at a predetermined price that is set today. And this is option because if that time comes, that individual is not obliged to buy. The person can buy, or the person can just ignore. I mean, does not buy. It's option like that way. Think the idea behind option is, in our finance class or even some other statistics or economic class, if you heard that something about investment, that if you invest some money today, you expect some positive return on it, so that in future you can earn or you can have more than the amount you initially invested. So you mean you can expect some profit, your wealth maximization. I mean, your wealth will grow in future time. But say you don't have money, or you don't want to buy stock, but you want to invest in a stock. Or if stock price up, then if you invested, then definitely you can make money, because the price you gave to buy one stock, now the price is higher, so the difference would be your profit. But still, if you did not buy a stock, then if stock price up, then how can you make money? That's a weird question. Or say stock price is going down, I mean falling, then how you can make profit out of that? Since it seems still it is a weird question. So if you think you don't have money but you want to invest in stock, if you think if stock price falls down, then still you can make money. Or if you think you you can protect your profit if stock price going down, if this is the scenario for you, then financial option would be the best case. Here you can invest in stock without having money. You can make money if even stock price falls down. You can protect your profit if stock price falls down, even um, without or with a minimal amount of investment. So this is our financial option. Let's dig further into this chapter. um, what's the single most important characteristics of an option? It does not obligate its owner to take any action, meaning since it is an agreement between buyer and seller, so if future time comes, buyer are not buyers are not obligated to buy the things, I mean, they initially agreed upon. And it merely gives the owner the right to buy or sell an asset. So if buyer thinks in future that, okay, buying that stock or a financial security is not a good option, or is not a profitable decision, then just ignore it. Or if it is a profitable decision, or you can see the visualize the profit, then you can buy it. This is the simple important characteristics of an option. So let's understand several terminology related to option pricing. Is call option and put option. Just read this definition. Call meaning this is from buyer side. Think you are the buyer of an stock in future date. So and I am the seller. So we agree we agree to make an exchange transaction of an stock in future date. So I agreed that I'm committing you to sell my stock in future date, the price we determine today. So this is the call option, and you have the option to ask me to sell the stock in future date. And put option, just think the other way around. After 3 months, I will say, okay, since this is a put option, so I want to sell it, and then you have to buy it. You don't have any option to ignore it, but I have the option to sell or not to sell. So just two opposite direction of the option. I mean, exchange. Strike price. or exercise price, this is the price we stated today. Meaning, if it is call option and you agree to buy stock in future date, so at what price you will buy the stock from me in future date? So that price is the stock or exercise price. And expiration date, uh, think this agreement is for future transaction. So future transaction should have some predetermined time. This should not be for 10 years or more or undefined time. So this is not the case. We should set certain time period, maybe 3 months, 4 months, or 9 months, or even 12 months. That's it. After that date expire, there will be no validity of the agreement that made between you and me. And then exercise value meaning when the future time comes, and if you call me to sell the stock, how much money you can make it out of that exchange transaction. So that is the idea. So exercise value we can get by mm, the difference between current stock price minus strike price. Strike price, again I am saying, this is the predetermined price that we agreed upon today for future transaction. And current stock price meaning the market price of the stock at that time in the future. So the difference between current market price and strike price versus a zero, which one is the bigger. So that's the exercise value. Of course, this should be bigger, because if it is lower than zero, that's a negative, meaning you will not exercise the option, because this is your loss. Okay, and option price, this is the market price of the option contract. This is, say, I agreed to sell my stock to you after 3 months at a certain price, say $80. $80. So in 3 months, in 3 months, within 3 months, if you call me to sell the stock, I have to sell at a price of $80 per stock, no matter how much is the market price or not. If market price is $90, still if you call me to sell, I have to sell the per stock at a $80 price, no matter the market price is $90. But why? What's the incentive for me to hold this stock for you within 3 months, that whenever you will call me, then I have to sell it by $80? So what's my incentive as a seller, right? So if you just say, okay, let's have an agreement that within 3 months, if I want to buy any stock from you, you have to sell me that stock at a price of $80 per share. So then what's my incentive to hold this right for you? So you have to pay me some money today. So maybe per share you pay $2. So if you pay me $2, then I can hold this right, this agreement for you, valid. Otherwise I have no incentive, because uh, after 3 months, or within, end of these 3 months, if market price is $80, so what's my incentive to sell the same stock $10 less to you? Nothing. So that's why you have to pay me $2 today to hold this right for you. So this $2 is the option price, right? Okay, time value is the option price minus exercise value. So this is the difference between option price and exercise value, meaning if you exercise before the agreement time expire, uh, that point of time to the expiration date. So you have to have the money, value for that period. So that's the time. Is the additional value, because the option has remaining time until it expired. Writing a call option meaning, this is from a seller point of view. You can write any option, and you can sell it for the option price. That price may be minimal, $1, $2, or so, but still you can make money. Okay, covered option meaning, you can create an option, you can write an option, but you have to have a stock behind it. That's mean you have stock in the back end. So no matter if the stock price goes up or down, that will not affect your trading. You don't need to think of, because you have it already. But a naked or uncovered option meaning you don't own any stock. You don't own any stock, but you made an option. So in case the option is exercised, then since you agreed to sell stock, from seller's point of view, then you have to buy the stock from the market and then sell at a lower price to the buyer. So this is kind of riskier. And in the money call and out of the money call, and other option is on the money. So in the money meaning you have some profit. Out of the money meaning if this is a loss. So if this is a loss project, then definitely you will not exercise. And on the money meaning there would be no loss, no profit. Lips, this is another option, but one important thing is that the maturity period of this option is almost 2.5 years. So this is the idea, but normal option is 3 months, 6 months, or 12 months. That's it. Okay, so there are several things. Okay, now as I said, to make this agreement, I mean, to hold this agreement or right for the buyers, seller needs some incentive, meaning needs some money to hold this right. So that money is the value of option. And how we can estimate the value of option? So there are several ways. Number one is the binomial option pricing, and another one is Black-Scholes model. So these two are very popular. So binomial option pricing model works this way, meaning consider two ways. If after 3 months, for example, 3 months option price, if stock price goes up or down, then how much would be the cash flow effect? So this is the option pricing payoff, meaning exercise value we already talked about. So in either case, we are thinking that okay, if option price goes up, still our net payoff would be $13 26 cent. If stock price goes down, still we can have this stock price. So if we just discount back to here, um, then how much would be the price of the option? Okay, let's solve some of the mathematical problem equations. So option pricing equations, we have this exercise value. This is the difference between current price of the stock and stock price versus zero, which is which one is the max, is the exercise value. And say if we use Black-Scholes model, we have to use this one. Put call parity, we have to use this one. Value of put option is this. So this is a simple model or equations for this chapter to solve mathematical problem. Let's see our homework assignment. Option, say homeworks, start. Okay, so this is our first problem in homeworks. So let's open Excel sheet, practice problem. Okay, before going to this problem, let's solve this problem we have here. Brighton Memories stock is currently trading at $50 a share. Call option on the stock with $35 strike price currently sells for $21. What's the exercise value of the call option and what's the time value of this option? So these are the uh, values we have. These are the numbers we got from this problem. Let's see stock price. From this problem, how much is our stock price? Is stock price is $50, $50, and then strike price $35, and then currently sell, I mean the value of the option is uh, $21. Now what's the exercise value of option? Exercise value of option, let's go to our formula. Exercise value of option, exercise value of option meaning current price of stock minus strike price. So think current price of stock minus strike price. So current price, this is the strike price 50, and strike price is 35. So the difference between this and this. So let's see the formula: C4 minus C5. So C4 minus C5, that's our $15 exercise value option. And time value option meaning we need to just option price minus exercise value. So option price, so this is our option price minus exercise value. What's the exercise value? mm, Sorry, market option of the price, market price of option minus exercise value. So option price is $21 and exercise value of option is $15. So this minus this, let's say C6 minus C8 is the time value of option. So these two are our answer. So let's move to our problem. uh, A call option on the stock of Bedrock Boulders has a market price of $8. So market price is $8, 8, and then the stock sells for 30 share. So this is the stock price 30. What's the strike price? 26. 26. So we have exercise value of option is $4 and time value of option is $4. So 30, 26, and 8. So 4 and 4. Let's try 4 and 4. Check the work. It works. Okay. Let's go to the second problem. Exercise price on the Flanagan company's options is $15. Its exercise value is $25. Its time value is $5. What's the options market value and price of the stock? So let's get the value we have from this problem. Okay. So exercise price on a Flanagan company's option is $15, meaning exercise value $25. This is exercise value. So just I'm putting here 25 and time value is 5 and option exercise price is how much? $15. And understand option price of the market. So this one we need to get, and price of the stock, this one we need to get. Now think how we get time value of options. Time value options, option price minus exercise value. So do we have values for option price? We don't we need to estimate. Uh, now or the strike price. What's the strike price is where? 25 stock price, exercise price. Sorry, exercise price is this. I used it. Okay, so this would be this. Now let's see how we get time value of money. Time value of money we get option price minus exercise value. So option price again we don't have, and time value we have. So let's see. So then if this is the case, so our time value of money equals option price minus exercise value. So we can get it. So time value equal 5 and then exercise value equal 20. Exercise value equal how much? 25. Okay, how I get 15? Exercise time value of option equals option price minus exercise value. So we have time value of option is $5, exercise value is $25. So if we just flip this equation, then we can say option price. Options price equal would be this plus this. How? Let me open one thing. If this is the case, then can we just write in the next line equals time value option plus exercise value. So time value of option plus exercise value. So this is our exercise value and this is our time value of option. So if we just add these two together, we get this one. And now what's the second question is price of the stock. How we can get price of the stock? Price of the stock, let's go to our equation. Current stock price minus strike price. Exercise value exercise value, this equal stock price minus strike price. Uh, market price of option equals stock price minus minus strike price. So in our case we have stock price, we don't know, but if we want to get stock price, can you just write stock price equals market price of option plus strike price. So market price of option plus strike price. So market price of option is this. No, how is that one? So exercise value. I got wrong idea. So current stock price minus strike price, exercise value. So exercise, this should be exercise value. Exercise. So that way, exercise value. So our exercise value is $25 and strike price is this. So if we just sum these two together, then sum. So 15 plus 25. So 40. Our answer is $40 stock price and $30 market price of option. So let's move in. Market price option is 30 and then 40. Second option is okay. Black and Scholes model. So for Black and Scholes model, I have one Excel sheet. So this is the formula, and then formula is just this one. This one. This is a Black and Scholes model. So I already incorporated everything. So you just need to change the values here. So let's see. We have the following information. So current stock price is $16 and change the values in yellow cells only. Strike price of option is how much? Again 16. Time to maturity. So time to maturity is 9 months, and so then 9 over 12 months. So that would be T equals 0.75. Risk free rate is 7%. Variance of the stock. Variance of the stock is 0.15. Sorry, 0.15. D1 0.32423 and D2 negative 0.01118 and then ND1 0.62712 then 0.49554. So we see 2.11. So the value of the option to round your answer to the nearest cent. 2.51, say 2.51. Check our work. It's okay. It's working. And then second one, put call parity. Put call parity. So I have this one. Uh, the current price of a stock is $34. Annual risk-free rate is 3%. A call option with a strike price 31 with 1 year until expiration has a current value of $6.02. What is the value of a put option written on the stock with the same exercise price and expiration date as the call option? Okay, so get the figure we have. Current price of stock. Current price of stock is $34, and then risk free rate is 3%. Strike price is $31, and time to month 1 year is 12 months. So current value $6.02. So this is our idea, $2.10. 2.10. Let's check. Yeah, that's it. So use this to Excel sheet to solve our homework problem, and just change your number on the yellow cells and you'll get the answer in green cell. So thank you very much. Still, if you have any problem, let me know and let's figure it out. And wish you a good luck on this chapter. Thank you.